Starting out in Forex, there are plenty of similarities between the Forex market and the equities market. However, there are also a lot of differences. Here we seek to take a look at the differences and see how you can start off trading in the Forex market. Picking a Forex broker. Before you can begin trading in the Forex market, you will need to open an account with a broker. There are plenty of brokers to choose from, each providing certain services that the next one may not have. In order to make the best choice, let's consider a few things to look for. Number 1. Thinner spreads. As we saw earlier, the spread is the difference between the bid price and the ask price at any point. Since you will not be asked to pay the broker a commission every time you make a trade, this difference in spread is how Forex brokers earn their money. You want a broker who is able to provide lower spreads such that you get the opportunity to make even more money from your trades. Number 2. Look for top-rated brokers. Equity brokers may not need any links to large banks since they do not offer a lot of leverage. However, Forex brokers do. Do a background check as to which institutions the broker is tied to. Ensure that your choice broker is registered with a recognized body such as FCM or Futures Commission Merchant Trading Commission. This information is usually available on the website. Number 3. The more the tools and information, the better. The best Forex brokers have different trading platforms. They come with news, data, and technical analysis. Before you decide on a Forex trader, ensure that they allow you to take these different platforms for a test drive. They can simulate real-life trading experiences. You will also get fundamental analysis and economic events that could affect price movement. Number 4. Leverage. Forex is the least volatile market out there. This is why you need leverage if you hope to make significant returns on your investment. This is the money that your broker will provide you in order to trade efficiently. A leverage of 100 to 1 means that you get 100 times the value of your investment. Some brokers will provide you with as much as 250 to 1. However, keep in mind that the more leverage you have, the more you stand to lose. Number 5. Different types of accounts. The best Forex brokers have different sized accounts to cater to the needs of different clients. A mini account allows you to trade with an initial investment of as low as $250. This comes with a high leverage to compensate for the small investment. For you to trade with a standard account, you need a minimum of $2,000. The third type of account is the premium account, which has an even higher initial investment but comes with additional benefits. Things to stay away from. Apart from the positive things that you can get from your broker, there are also a few things to watch out for and avoid. These are: Number 1. Snipping. This term is used to refer to making transactions very near to the preset points and are unscrupulous acts done by shady brokers with an intention to raise their profits. Of course, you can never expect a broker to admit that they have done this, but if you find rumors associated with a particular broker, there is a high chance that it is true. Unfortunately, there is no website that can tell you which brokers are notorious at this. The best way to gather information is to communicate with fellow investors. Number 2. Strict rules on margin. You can expect your Forex broker to have an opinion as to how much risk you are taking on a trade. You are, after all, trading with their borrowed money. The Forex broker may trade at the discretion of the investor. This may not be a good thing. If you have opened a margin account and then suddenly your trade goes down and then it goes up again higher than the position you entered in, these are brokers who will close your position. This means that you will have missed out on a big move. It is thus important to check the margin rules with each broker that you are interested in and pick one that best suits you. Opening the account. There is little difference between opening a Forex account and opening an equity account. The one main difference is that with Forex, you need to sign a margin agreement. This simply states that you understand that you are using the broker's borrowed funds to trade, and it may choose to interfere with your trading to ensure the protection of its interests. As soon as you have deposited money in your Forex account, you can begin trading. Tips when starting out in Forex. Forex trading is a leveraged This means that the chance to lose a lot, if not all of your initial investment, is very real. This is why you need to observe certain precautions, such as: Number 1. Start out with a demo account. Some people will quickly open a real account and fund money only to lose it within a few trades. This is brought about by the lack of experience. To prevent yourself from doing this, it's important to start off with a practice or demo account. Once you have learned the ropes, you can then trade with real money. Number 2. Keep sentiment out of it. One of your greatest enemies when trading Forex is your emotions. You need to learn to keep them out of your trading. Otherwise, you will hold a position for longer than you need to and lose money. Always ensure that you put in place automatic stop loss and take profit orders. Number 3. Use the trend. There is an old saying in securities trading: the trend is your friend. If you want to make money trading in the Forex market, you need to make sure that you always take the trades in the direction of the trend.